What's up everyone, it's Caddy with MoneyVest. So in today's video, I wanted to discuss, there's been a lot of comments on our videos that Caddy, there's nowhere to invest right now. There's literally nothing where there's opportunity. I'm tired of waiting. What can we actually do? Because obviously I'm not aggressive in this market. I'm not aggressively buying in this market because we're pretty much trading back at all-time highs. We did see a bit of a pullback about a month ago where the markets did dip here about 4 to 5%. And I did deploy some capital, close to 10 grand back into the market, just buying a little bit of UG, SMH, Apple, Tesla, and they have performed really well since because markets have recovered back to almost new all-time highs, but there wasn't really a lot of opportunities or buying opportunities, so to speak, in the market. So I really want to take a page from Warren Buffett and Howard Marks in this video, kind of help you understand that even the biggest investors, the greatest investors, don't always invest in all market environments. In fact, sometimes they sit back and let the deals come to them. That's been kind of the analysis, the theme of this channel, is to help you better understand that some of the greatest investors don't force investments, they don't force trades. Instead, they sit back, they allow for the prices to come to them. Something that we have mentioned over and over again. So hope you all enjoy this video. I'm going to break down, some of the comments from Warren Buffett's most recent shareholder meeting, and also break down Berkshire Hathaway's, balance sheet and of course income statement. And at the end of the day, it's really actions speak louder than words, right? Because actions are what people actually do, and that's how they feel, that's how they think, as opposed to what they're saying, because actions, in my opinion, speak louder than words almost always. So again, hope you all enjoyed this video, find it helpful. Make sure that you drop a like and subscribe to the channel. I would really appreciate that. And again, links to our Discord and Patreon is going to be down below if you're interested in joining us. There is a 16% annual discount that's available until the end of this month, and also a lot of our individual courses, fundamental analysis, technical analysis, options trading, psychology, everything is going to be over 50%, also half off, and the coupon code is going to be May50, available until the end of this month as well. So this right here was the headline from Wolf Street, and Buffett invests in TBills. So as we know that Warren Buffett has been investing more and more into TBills instead of stocks, and waits for bad stuff to happen. And cash is king at 5+% interest rates. So reading further, you'll notice that at the end of March, the huge conglomerate held $153 billion in T-bills, right? That's basically treasury bonds, short-term, long-term bonds, including cash. So there's a lot of liquidity that Berkshire Hathaway currently has, and that's a lot of cash that they're sitting on, and that's up by $24 billion from 3 months ending earlier. So in December 31st, 2023, that's $24 billion higher, and up nearly $50 billion from March of 2023, so same time last year, and up $86 billion since March 2022. So in over 2 years, $86 billion increase. That's a lot of money. That's a lot of cash that they're now sitting on, according to Berkshire's 10Q filings. And the year 2022 was when T-bills began paying a noticeable interest rate once again. And if Berkshire earns an average 5.3% on its T-bills in the current quarter, that would be about $2.4 billion in interest income alone, with zero risk. Nothing is zero risk, just very, very low risk, because the reason why they're considered risk-free is because they're backed by the full faith and confidence of the U.S. government. By comparison, it reported $15.7 billion in total pre-tax income in the first quarter. So the income from T-bill does really matter. And the T-bills cash and cash equivalents jumped to $189 billion in the first quarter. That's up by $21 billion in 3 months, and up by $59 billion year over year. So that again is a significant increase in the actual cash and cash equivalents. And the noticeable, the surprising, and the interesting thing is that Berkshire Hathaway did sell about 116 million shares in the first quarter after selling 10 million shares in the prior quarter. So that is most certainly some very aggressive selling from Warren Buffett and Berkshire Hathaway of their one of their biggest and largest stock position, with still a value of $135 billion as of March 31st. Now, of course, he's not going to dump all Apple stock in one go, because that's absolutely going to tank the stock to probably levels that we have never seen before for Apple, and that would probably cause a huge exodus in the overall company. So Buffett praised Apple and the stock, and because Berkshire was still holding $135.4 billion as of March 31st, and he doesn't want to tank the shares before he can unload more of them. And I think that is going to happen. I think we're going to see more and more selling pressure for Apple here, because as I mentioned before in one of my previous videos, that Apple as a company is fantastic and it's one of the greatest, biggest brands in the world. But every company goes through cycles. Every company goes through a time period where growth starts to taper off. And I think Apple's kind of reached that inflection point where innovation is lacking. Execution is still strong on the back of course, great management and great brand. But really, at the end of the day, it's really more of an upgrade business as opposed to anything new. And for that reason, they have to kind of delve into more financial engineering with a significant amount of share buybacks, $110 billion worth of share buybacks to help boost their bottom line and earnings per share, even though net income growth is not as significant anymore. They're still growing, no doubt. They're still a great brand, great company, growing still at a good rate, but by no means they deserve 27, 28, or even as high as 30 times earnings multiple. So again, as prices go up, risk goes up, and future returns diminish. And for those reasons, again, there could be some tax reasons as well as to why Buffett is selling. But the bottom line is, they are selling at significant chunks here, and they are buying T-bills with those proceeds. So this right here is what the balance sheet looks like for Berkshire Hathaway. And you'll notice that this is the cash and cash equivalents and short-term investments in U.S. Treasuries. So combine these two numbers, 28, almost 29 billion and 153 billion, we come to, almost $180 billion for Warren Buffett and Berkshire Hathaway here. And of course, investments in equity securities sit at $335 billion, which is slightly down from same time last year of $353. Actually, December 2023, it's down about a little bit over $20 billion, in the last 3 months. And that, of course, has increased this number right here. So it's a pretty clear transfer. I mean, it's gone from equities over to fixed income. And that's what we are seeing from Warren Buffett and Berkshire Hathaway. So it's a straight switch again from equities over to fixed income, and that just goes to show it's very suggestive, right? These are actions. This is what actions really are. That Warren Buffett, of course, not finding great opportunities, and that's why he's sitting on a ton of cash, generating that risk-free rate of return of well over 5%, because Treasury bonds, of course, paying a very high rate of return. Now, everyone has a different thesis. Everyone is working with different capital levels. Everyone's dealing with different risk tolerance. So there's no comparison, and that's why I mentioned, no two portfolios are ever going to be the same. Remember that, right? With any market participant, you're never going to find two portfolios that are exactly alike, and the reason being is because everyone and every organization, every market participant, so to speak, has different variables at play, different tax jurisdictions, different risk tolerance, different objectives, right? Different financial goals, different liquidity needs, different capital allocation. So since everything is different, we can't expect the actions to be similar or the same. But the idea is the same, right? The idea is to generate the highest rate of return with the lowest amount of risk, right? At the bottom line, at the core of investing, that's what we're all achieving, or that's what we're trying to achieve is we're trying to achieve a high rate of return with the lowest amount of risk involved. And when you have, this much amount of cash sitting on the balance sheet, when you're not really invested in the equity market, that just goes to show that, okay, Warren Buffett finds it more appealing, more attractive to be invested in fixed income, generating a 5% rate of return than as opposed to equities or finding other opportunities in the market. And of course, getting rid of its largest position, Apple, and putting it into fixed income. Now, not saying there's not any opportunities at all, right? So that's not what I'm saying or what Warren Buffett's actions are saying. There's plenty of opportunities. I'll still strongly do believe that I think small caps are undervalued and have a lot of potential. I think there's opportunities in financial sector, communication services. But again, everyone's working with different objectives, different goals. So that's why we can't expect Berkshire Hathaway or Warren Buffett to be investing all that $150+ billion capital into particular sectors or, small caps for that matter, because they've got a different investing style altogether. Now, earning 5% plus risk-free while waiting for bad stuff to happen. Now, this last part, waiting for bad stuff to happen, there's nothing wrong with that, right? A lot of people think that, you're going to be waiting forever. You're going to be waiting, for the markets to drop, which may never happen. So it's kind of like timing the market. I mean, not really, because timing the market would be getting in and out of the market, every so often, waiting for the market top and waiting for the market bottom, and then trying to time that market bottom and market top. Really, what the difference here is waiting for bad stuff to happen is having dry powder ready. You're invested in the markets in general. You're invested, and then also having cash on the sidelines, having dry powder ready on the sidelines to take advantage of when those opportunities present themselves. I think I have a very similar approach that I would be about 70-80% invested in the markets long, because I do believe that I can long term, we're still very optimistic. Markets are going to flourish. Individual stocks are going to do well, but still also kind of playing around with that cash exposure. I may go from, 14%, 16% to 25 to 30%. and then again, quote unquote, wait for bad stuff to happen, wait for the markets to correct or pull back or dip or be in a bear market so that I can start deploying and be more aggressive. This is what Buffett said. I don't think anyone sitting at this table has any idea how to use it, the cash that we're sitting on effectively, and therefore we don't use it. We'd love to spend it, but we won't spend it unless we think we're doing something that is very little risk and can make us a lot of money. So again, lower risk, high reward potential opportunities, which there is a lack of and in the current market environment. And he also mentioned, giving us a baseball analogy, we only swing at the pitches we like, and right now they're not liking anything other than T-bills. And as the world gets more sophisticated, complicated, and intertwined, more can go wrong. And waiting for a big drop in share prices to put this cash to work at reasonable prices is what they're obviously looking for. And the company wants to be able to act when that happens, is what Warren Buffett also said. So again, it's all the idea of when the risk reward is good. And there's nothing wrong with being patient. And speaking of patience, Howard Marks has a chapter in The Most Important Thing, the book. It's patient opportunism. And this simply means allowing for the prices to come to you, waiting for investments to come to you rather than you going and chasing after them. You tend to get better buys and better deals if you select from the list of things sellers are motivated to sell. And I'll give you a very simple example. I've been negotiating on a house here in Dubai. I'm in no rush, right? I am not in a rush to buy a home, right? Because it's an investment property, I want the prices to come to me. So I waited 6 months, 8 months, 9 months. I was in no rush, and I waited long enough for the prices to finally come down to the level that I was comfortable with. And we, knock on wood, did the signing. The closing date's going to be next month. So hopefully everything goes smoothly. And again, I'm able to negotiate down to a price where I feel excited, and it's a price that's attractive for me given the current market circumstances, and the seller is motivated because they want to sell this property because they no longer have the use for that property. So it all comes down to being patient and allowing for the prices to come to us. There's nothing wrong with waiting and being patient. In fact, if anything, that is really something to be flexing and kind of mentioning that, okay, I was able to buy something at lower prices and I was able to negotiate a better price and a discount, which is only going to increase that future profit potential and reduce the margin for risk and for losses. And Oak Tree, again, from Howard Marks, he says that our motto is, we don't look for investments, they find us. We try to sit on our hands and wait for the phone to ring. If we call the owner and say, you own X and we want to buy it, of course the price will go up. But if the owner calls them and says that we own this and we want to exit this, of course the price will go down. So that is the whole idea that I wanted to address in this video. Is number one, of course, actions speak louder than words, and Warren Buffett selling Apple shares, slowly and steadily, kind of increasing that selling pressure. And of course, buying T-bills says a lot about the level of opportunities in this market environment. And the second is, again, there's nothing wrong with being patient, waiting for the markets to give us better opportunities and kind of evaluating the risk and reward on a constant basis. So let me know your thoughts down in the comment section below. Hope you all enjoyed this video, found it helpful. Make sure that you drop a like and subscribe to the channel if you're just joining us for the first time. And as always, happy investing. I'll see you all in the next video.